I'm sure this week hasn't been easy if you're holding or swinging stocks like I am. What about you?
Yep, a lot of ups and downs. I mean, this is what makes the market more interesting. Constantly going up all the time? Boring.
During the pullback, Dow, your so-called valued stocks that are sensitive to the economic cycle are the strongest. The tech stocks were hit hard, and so we'll take a look at next week's key market levels as usual.
I feel like this pullback is not over just yet. We still have more long-term risks looming, such as the supply chains issue, coupling with the upcoming holiday season and China's US tension are not easing anytime soon. We will have to watch closely on that at the G20 summit at the end of October.
Speaking of China, we will also talk about the restrictions on the power usage recently and how that will impact US companies like Apple.
And at this slightly long-term risks are still over our head. We need to have some strategy to hedge against it. Today, we will talk about one common way that I'm using, which is accumulating some dividend stocks.
But before we get into that, as usual, hit that subscribe button for us.
So a lot of people probably think that dividend plays are boring and useless now, but let us show you some logic behind the dividend strategy. Maybe you will like it by the end of this video.
Yep, at the end of the day, not every strategy is perfect. Each one has its strength and its weaknesses.
So I'm sure everyone knows the basics to dividends. So let's skip that and talk about some lesser known benefits and special characteristics.
All right. So, first, a lot of people think that there's no stock gains for dividend stocks, but that's not always true. Let's look at McDonald's, for example. This is McDonald's performance in the past 20 years. It went from 35 to 240, which is about 580% growth, beating the S&P's return of 180% over the same period of time.
Wow, that's pretty impressive. But if you include the dividend we invested, the return will hit 957%. And McDonald's is not only one. Since 1960, dividends have accounted for about 33% of S&P 500's total return.
Also, people think that dividend stocks growth potential is limited. That is also not accurate. Based on Drexel University's research, between 1982 and 2011, S&P 500's annual return is 11%. High dividend stocks annual return is 13%, and low to no dividend stocks annual return is 9.6%.
And the low to no dividend group are the growth stocks that we commonly know. The high dividend stock actually beats the growers.
But as of course, we know that in the past year the situation is kind of different since there is currently massive QE. But this shows that in a normal market, well, let's use 1982 to 2011, dividend stocks don't always have no growth, and no dividend stocks don't always equals more return.
Just to go back to your point on now being a special time period, this reminds us that the market is always changing. And it is important to know that nobody can save for certain for the future.
Exactly. And we're definitely not telling you or recommending you to abandon growth stocks and start dividend strategy, but we would like you to abandon stereotypes and think about what you prefer and weigh the pros and cons.
There's a big benefit for using dividend strategy. It is good hedge against volatility in the market. When the volatility is high, dividend stock usually have the best risk return ratio.
Yep, according to Drexel's research, the SHARPE ratio for high dividend group, low dividend group, and S&P 500 overall group are as following: 0.53, 0.27, and zero point 0.4. So SHARPE ratio is a measure of risk adjusted return. So obviously the higher the better.
Interesting. High dividend group even beat the index, which is known for its risk and return. Remember when Buffett says just buy the index ETF and leave it.
Yep. And using Sharpe ratio to evaluate makes sense since the 30-year period from 1982 to 2011 is the most volatile period. We've got the 1987 stock market crash, the Gulf War in 1990, Asian financial crisis in the 97, the dot-com bubble in the early 2000s, And oh, let's not forget the '08 financial crisis.
Wow, that's quite a resume when it comes to volatility. So dividend strategy has demonstrated that it is the best performer when it comes to volatility. Also, that makes sense since generally the dividend payers are usually blue chip stocks. They have low beta and consistent profitability. So when times are rough in the market, they are more resistant to dips, which means they will get more love from the investor.
And the market is actually kind of in this situation right now. We have risks piling on, less and less good catalysts, and everyone is ultra sensitive to pullbacks.
I agree. Again, we are not saying now is time to change plans, but we are asking you guys, the rational investor, to strongly think about this strategy.
Exactly. I think time is running out for us on this topic, but we will recommend some good dividend companies next week. And if you like this strategy, sleep on it and come back to us next week for some recommendations.
These are the sneak peeks of companies we will be talking about.
Let's talk about China. First, Evergrande warned last week it could not meet interest repayment on its 400 billion debt. And on Friday last week, China's central bank announced all transactions and mining of cryptocurrencies were illegal. And now China is restricting on power usage due to coal supply shortages combined with high power demand from the manufacturers.
Wow, what can you really do in China now, right? Well, when you talk about that, the first thing that came to my mind is, will I get my new iPhone on time? This is definitely going to interrupt Apple's production line.
Just Apple, I think we're going to have shortages of many common goods and products. So you better do your Christmas shopping early this year.
That's the plan. But what's behind China's power crunch?
It's pretty simple. Coal prices skyrocketed this year, and China gets around 70% of its power from coal sources. The supply of power is greatly reduced because coal powered companies are unwilling to produce electricity at a loss.
I thought this is more of a tightening up regulation over non-carbon dioxide emissions. China is aiming to make the country carbon neutral by 2060.
Wow. That's I mean it's still 40 years, so I think it's doable. And that's I'm sure that's part of it.
Part of it. What else is behind this move?
All right, then let's take a step back and take a quick look at China's export number in August. It went up nearly 25% year over year. It's crazy, right?
Yep, not just the month of August. We also saw an export surge of 32% in June and almost 20% in July.
It makes sense. And it's also funny when you think about the amount of effort everyone was putting into getting out of China due to the US and China trade war. And now the only place where you can get the goods made is in China.
Based on the export number, it looks like they are doing a pretty good job. Then why does the central bank inject 150 billions to stimulate the economy?
Well, simply because the industrial profits are shrinking due to raw material prices constantly going up. China is the world's biggest importer of crude oil, coal, iron ore, copper, and also natural gas. Production lines in China heavily rely on these external resources to sustain the current output, but now it gets to a level where manufacturers are not making much money. Profit margins for export producers drop from the double digits to as low as 5% or less.
Wow, I thought they were banking on those export number, but they are kind of struggling to survive.
A bunch of old and new suppliers and assembly lines heavily invested in the new production lines and equipment to support the surging demand, while other foreign countries are still battling the pandemic.
Now, as other Southeast Asia countries slowly recover and production capacity gradually recovers as well, a good percentage of companies will once again move out of China to exploit cheaper labor and mainly to dodge tariff imposed by Trump.
Sounds reasonable, but once demands are distributed back to the neighboring countries, suppliers and assembly lines in China are going to have a price war with each other for survival.
Just my assumption. I think China is limiting power usage as an opportunity to curb production expansion. And this means a lot of downstream production and assembly line will get eliminated to ease up the financial burden of the Chinese economy. We are expected to see China place less reliance on its export and place a greater focus on the domestic market or internal circulation. What do you think?
Yeah, I pretty much agree with that. China wants the extra production capacity reallocated to other products so they can support domestic market and obviously rely less on imports.
All major indices weekly candles were looking pretty ugly until Friday came around.
Yeah, the Dow Jones were down about 1,000 at the low of the week, and the 200 MA is right around the support area at 33,500. This may be an opportunity soon.
Yep. And the S&P 500 make a new low this week at 4,288 and bounce off from the support area around 4,300. We gotta need to clear that upper resistance around 4,375 to continue higher.
Tech is looking weak this week. The Nasdaq were down about 5% at some point and closed right around support on 14,790. Something I thought it was interesting, the Nasdaq reacted to gap back in July 1st. This level should also be a level to watch into next week.
Again, not much on the small cap, still trading inside the box range, but they are the best performer for a down week like this one.
Thank you for watching. If you find this video helpful, feel free to give us a like and subscribe for more content like this.
There's a big benefit for using dividend strategy. It is a good hedge against volatility in the market. When the volatility is high, dividend stocks usually have the best risk and return ratio.